Watch carefully. If you're a UK retiree with money in a savings account, the next few minutes could save you hundreds of pounds in unnecessary tax. A little-known deadline is approaching, and millions of pensioners still have no idea it exists. If you leave your savings where they are, you could end up paying more tax than you need to after April 2027. Before we continue, hit like and subscribe for more updates that help protect your pension and your money. Let's get started. Many retirees believe that once their state pension arrives, the tax side of life becomes simple. Unfortunately, that's no longer the case. Interest earned on savings can quietly push you into paying tax, and because banks automatically report savings interest to HMRC, you won't receive a warning before it happens. This is becoming more important because the gap between the full state pension and the personal tax allowance has become extremely small. That means even a modest amount of extra income, such as interest from a savings account, can make a real difference to your tax position. Many people also confuse the personal allowance with the personal savings allowance. They're completely different. The personal savings allowance lets many basic rate taxpayers earn up to £1,000 in savings interest tax-free each year. But once your interest goes above that limit, tax can become payable depending on your circumstances. With today's higher savings rates, it doesn't take a huge amount of money in the bank to reach that threshold. Thousands of retirees who never expected a tax bill are now discovering that their savings have generated taxable interest. In many cases, they didn't do anything wrong, they simply didn't realize how the rules work. And here's where things become even more important. According to the information discussed in the transcript, changes affecting savings taxation are expected to take effect from April 2027, making it even more important for retirees to review where they keep their money before that deadline. One of the main options highlighted is moving eligible savings into a cash ISA, where interest is generally sheltered from income tax. But that's only part of the story. In the next section, we'll explain one little-known allowance that many pensioners completely miss, why some people may have been paying tax they didn't actually owe, and the simple step that could help protect more of your savings before the April 2027 deadline. Now let's look at one of the biggest opportunities many retirees don't even know exists. If your total non-savings income, such as your state pension and any small private pension, is below a certain level, you may qualify for something called the starting rate for savings. This is completely separate from the personal savings allowance, yet many people have never heard of it. According to the transcript, this allowance can let eligible savers receive up to £5,000 of savings interest at a 0% tax rate, depending on their overall income. That means some pensioners who believed they owed tax on their savings may actually have paid more than they needed to. The transcript gives an example of a retired pensioner whose savings interest fell entirely within this allowance, meaning no tax was due on that interest. It also explains that for some people, the standard personal savings allowance isn't even needed because the starting rate for savings already covers their interest. There's another important point many retirees overlook. Banks and building societies automatically report the interest they pay directly to HMRC every year. If too much tax is due, HMRC can recover it through your tax code or issue a formal assessment. Many people are surprised when this happens because they never receive a warning beforehand. The transcript also explains that if you believe you've paid tax on savings interest that should have been covered by the starting rate for savings, you may be able to reclaim overpaid tax using the appropriate HMRC process. Looking ahead, the transcript discusses changes expected from April 2027, including changes affecting how savings income is taxed. It highlights that money held inside a cash ISA remains outside the income tax system, meaning the interest earned there isn't subject to the savings tax rules described. For many retirees, moving eligible savings into a cash ISA before the deadline could help reduce future tax exposure. The key message isn't to panic, it's to plan. Understanding how these allowances work, checking how much interest your savings generate each year, and reviewing whether a cash ISA suits your circumstances could make a meaningful difference over time. If you found this video helpful, don't forget to like, subscribe, and turn on notifications so you never miss important updates affecting UK pensioners and retirees. Thanks for watching, and we'll see you in the next video.